Hey, Renter Retires. It's Adam Schroeder here for another episode, and I am once again joined by the man, the myth, the legend, Zach Lemaster, and we are once again joined by one of our top lenders, that is Aaron Chapman. He is here to discuss that minor thing that people are occasionally talking about in today's marketplace, and that is the interest rates. So, gentlemen, welcome.
Aaron, thanks for joining us.
That a minor thing, yeah. The interest rate barely comes up these days.
Yeah,
it's just something we glaze over, right? I mean, this is just, for all of us though, in all seriousness, it's this is not something where the sky is falling. Yes, it's a concern and it affects business, but this is just another point in history, right? We go through all these things, we press forward with our investing goals. And then we want to provide education from professionals like yourself, Aaron, who's in the mortgage industry and who is a professional investor still that's investing today, right? This is not interest rates, even though they're a little volatile, they're going up. We've all been spoiled for a little bit. This is not slowing down your personal investing, right?
It has not. In fact, I just picked up 2 more properties out in Florida. They're going to go under construction. And so now when you think about that, I bought the lots, paid the cash for the lots, and now I got to sign the contracts on the builds. But we know how that's working when you sign contracts on builds these days with supply chain. Costs are still going up, right? And then interest rates are still going up. Inflation's still going up. So that puts me in a position. Everything I signed in a way is BS. It's changing significantly. So I want people to know I'm involved in the exact same thing they are. And I appreciate you pointing that out.
Let's talk a little bit about just, and I know Adam's got a plethora of questions for you, but obviously working in the mortgage industry, like what's happening right now? No one has a crystal ball, but in your perspective, what does the future look like? How should people be thinking about these rates? Adam, anything else you want to throw in to get Aaron's opinion on?
No, I think the only thing I can think of is, how you have been approaching people who, we've seen mortgage increases before. I haven't seen anything that shows, a doubling of mortgage rates in 2 months, which is, I remember it was late January, maybe early February, whenever I closed my last property with you, and I got 4 1/8, and if I want to invest today, it's not 4 1/8 unless I spend,
no, it's not. And
unless I spend the same amount as I did on the property to buy myself down.
And I remember the conversation that we had there, because you were in the mid to high sixes at one point, and then say, hey, maybe it's going to get a little bit better, and it never did. Right, until you finally reconcile and say, hey, we're just going to go with the 4 1/8. And that's unfortunately what a lot of people are they're used to doing. If I hold out just a little bit, it's going to go back down, which it has been. Historically, we've seen that consistently for the last few years. And as you said, Zach, we've been spoiled. And what I want people to feel like is we're still spoiled, right? And the reason I want them to feel that way is because where are we at with inflation? What's the rate of inflation today?
8.5.
8.5. That comes from where?
The government. And
that is what index?
CPI.
CPI. It's a consumer price index. I'm going to see if I have sharing capability here.
Yep.
Yep. I should be able to. Yep. Let me selection. Yep. So I'm going to show you guys something here. You guys have probably been here, and I'm sure you're. I
have a feeling I know where we're going here.
Yep. We're going to shadow stats, right?
We're going to shadow stats.
And so I'm going to, and everybody, I'm sure most of you guys have talked about it. It's probably come up several times on the podcast, but I want to share again where we are. If people haven't looked at this recently, they started tracking inflation back in the early 80s. As we can see here, it was just one line. And then you start getting to the point where they started deciding, wait a minute, we can segment some of these things out, because it really is, these are some volatile metrics, and we'll stick with the things that can stay consistent. And what inflation tracking was supposed to do, the consumer price index was supposed to do, was track the average person's lifestyle, or any person's lifestyle, and say, what is going to be the cost year over year to maintain that lifestyle? Then they started taking certain things out: food costs, energy costs, segments of housing, because they're volatile and they fluctuate quite a bit. And the Federal Reserve can't manipulate with monetary policy. So they started stripping that out. Then they started the substitution process, and it gets really long into the describing of what they did. But what we can see they did has had an effect. The red line continues to follow the CPI as the federal government had structured that index, and the blue line follows what it started out to be. And so you've got John Williams, who put together shadow stats that shows that divergence of the two. So if we get all the way over to the right, where we are today, 8.5% with CPI, Then you go to shadow stats inflation numbers, adding everything back in, we're probably closer to 17. Probably about 16.5 is what I'm guessing. So 16.5% compared to what they're trying to claim it really is. Now, what I'm trying to explain to people with this, when was the last time we saw this rate of inflation? Do you guys know?
It'd probably be the 70s.
Yeah, I mean, looking at the graph, right? I think when they just started to track it. I mean,
exactly. So all the way back in the 80s, right? And so we go back. So that was 1982, and it's actually slightly lower than where it is today. So inflation was a little bit lower than where we are today back in 82. And I'm going to show you, what do you think interest rates were back in 82?
Interest rates in 82 were what, like 14, 15%?
That's a little bit scarier than that.
18?
You see here, where we go. We were at just approaching 19% back in 1982. So I want people to really wrap their head around the fact is that our interest rates, are mirroring the inflation that we had back in the early 80s, but where are our interest rates? So I had to draw this in. I had to white this bar out, right? Because this is the graph didn't go where it needed to go. And I drew this in to kind of mirror where our rates are. And this is referencing owner-occupied rates. We know the owner-occupied rates are about a point to a point and a half off of investor rate. So most people could look up and see what is being widely published about interest rates. Just know, add a point to a point and a half to that, you're going to get the interest rates for the real estate investor. So we're here showing just over 5% for owner occupied as of today. But what's the difference between where we were in the 80s to where we are here? That's a massive gap. That gap should be filled. So have you guys ever heard of the Taylor method?
I have not. Oh, the name sounds familiar, but I don't know anything about it.
And I think I've got to remember if it's Taylor method or if it's Taylor.
Which also, by the way, Adam likes to refer to the gap between inflation and current interest rate as interest rate arbitrage, right, Adam? Did you coin?
100%.
Big fan.
That's exactly where we're heading with this conversation. So the Taylor rule says that if you want to quell inflation, right, that the federal fund rate has to take the target rate. What's the target rate of inflation? 2%. And then they have to take the current rate of inflation and figure out the gap. So what's the gap between 2% and 8.5%?
I believe last I checked, it was 6.5.
Yep, 6.5, right? So simple math. So what you do is you cut that in half, which is now 3.25, and add 3.25 to the 2% plus the current rate of inflation. Then you get the rate that the federal fund rate should be. So where does that put us at? If we have 2% target rate, 8.5% inflation, that puts us at what, 10.5 right there. Then you add the 3.25. Now you're at 13.75%. The federal fund rate should be at 13.75% to quell inflation according to the Taylor rule.
So you're talking about a doomsday here, Aaron? Is this, or what translate this back to? What does this mean for investors right now? And what should we be thinking about and doing in this environment? There's so many people that want to step aside and say, this is just chaos. Or they're running their cash flow calculator, which I know this is another soapbox we'll let you get on, which we love to hear. But they're looking at, okay, now my cash flow is $50 less than it was. This isn't the right deal for me. I'm not going to invest right now. We'll sit and wait. Maybe it'll fizzle out. What would you say to that?
Well, so the one thing about the cash flow calculator, because we live in an inflationary environment, what the heck is going on with rental rates? Are they going up or are they going down?
Oh, they're skyrocketing right now. Yeah. I mean, I'm given at least 9-10% increases on properties across the board.
Yeah. So national average, we're looking at 9-10%, right? Actually, if you look at the national average, it's now 12%.
And we've seen some markets like where you're personally investing and us as well in Southwest Florida, we experienced a 22% just over 2021. It's crazy how much rents. I mean, that's obviously an area where there's lots of population growth beyond supply and demand, but yeah, nationally, absolutely. Inflation, I always say inflation is a tool when you have a hard asset like real estate because it causes appreciation and rents to go up. People don't understand that inflation causes appreciation as well. But then above and beyond that, it's also you can mitigate your exposure to inflation and use it as a tool. So anyways, please continue.
Long-term investment in real estate with leverage. That's a key part of it, though. It has to have leverage, is where you get to actually invest in inflation. That's the one thing people are like, well, if I could just figure out a way to invest in inflation because it's going crazy. Well, this is how you do it. This is the one vehicle I've discovered. I don't know of any other vehicles because really I don't look at anything else. But in reality, this is the perfect vehicle to invest in inflation. So the reason I bring up the rents, you brought up Southwest Florida. We go over to the other side of Florida. Miami has seen over 30% increases year over year in rents, right? You've got other markets that are seeing 20s and high teens. I'm in Arizona. We're seeing the high teens, the low 20s. You get to Minneapolis, Minnesota, you're seeing actually in the tank. It's like negative 17% last I saw. You guys know why that would be?
Well, without getting too political, I think we talked about this last time.
You set shit on fire, especially when it comes to police stations. It changes how many people want to live in the area. So, but the reason I bring that up is because that's why you have a middle ground of 12% when you're looking at a national average. So I like to use the number 3%. 3% rent raises just to really add some color to exactly how powerful that becomes. So when people look at their cash on cash return metric and they get really, really kind of disappointed about that first year, I'm like, start looking at the area and what it does for your rents 3, 4, 5 years down the road. That's when everything starts to get really, really cool. So we're going to use the metric of 3%. I'm going to have you guys do some math. It looks like Adam's got his pen and paper ready to do this. His calculator ready to go. So we're just going to get really simple. I know some people may argue this deal doesn't exist anymore because houses are going so expensive, but I need the math to be simple for the purposes of our deal. So $100,000 acquisition, 20% down. We're going to do a 30-year fixed loan, $200 a month in cash flow with a 1% rent to value ratio. That sounds like a fair way of proceeding. Anything about that sound wrong?
Simple numbers, definitely conceptual. So
okay,
let's
conceptual. All right. So if you bought $100,000 property and you put 20% down, how much did you invest in the deal, dollar wise?
Put in 20 grand.
20 grand, right? So that means you financed what dollar amount?
80,000.
And you have 2 jobs as the CEO of your real estate investment business. Everybody listening, you have 2 jobs, right? You're the CEO of your business. You make the decisions. When you got to figure out who to work with. We're kind of on the rent to retirement thing. So I'm going to say these guys, that's your operations division. They're going to run your operations for you as far as finding the right markets that also introduce you to the right people who source, acquire, rehab, manage, maintain your business. That's an entire operations division for free. And a very damn good one, by the way. And this is not me just humping people's legs. This is the truth. You guys are doing a hell of a job. So then you've got the right lenders you got to bring into it on the financial piece of it. Anybody can write a loan. What's funny about the lending rules, they love to separate people by what's your interest rate and how fast you close. Well, if you don't even have anything remotely viable on those 2 metrics, then you shouldn't even be in the game, right? That shouldn't be your question. There's more to it. We're going to get into that more to it, part of it. The other job that you have is to find a property that you can keep reasonably rented for the entire time you own it, and you can raise rents on. You can do that, you've done your job. So we're going to say that job was done. If that job is done correctly, who pays off that $80,000 loan?
Your tenant.
The tenant. So we're going to take $80,000. We're going to divide it by 30 because that's how many years it's going to take the tenant to pay that off for you. And you're going to give me a dollar amount. So taking 80,000 divided by 30, and that tells you how much per year the tenant is paying off averaged over 30 years.
$2,666 and 66 cents.
And 66 cents, right? We have those cents that's an important number. I always tell everybody, go right to the penny. Now hit your divide button, divide that into the 20,000 that you invested because that's your investment. You invested 20,000. It's now growing an average of $2,666.66 per year for 30 years. What is that percentage?
I don't have my calculator actually out, but it's somewhere around 12 to 13.
It's 13.33%. Everybody listening can do this. Take $2,666.66 to hit the divide button, type in 20,000.
Now I've got my calculator up.
Growing by 13.33% every single year. That's before any cash flows. That's before tax benefits. That's before hedge against inflation. That's just amortization of the loan using somebody else's money, right? So we've got that metric. So we know you're already winning right there. So then we flip into the cash flow piece of it, right? We said it was a 1% rent to value ratio. Adam, can you tell everybody what a rent to value ratio is?
Yeah, it's when you take your rent and you figure out what it is compared to your value. So $100,000 home, take 100,000, multiply it by 1%, you get $1,000.
$1,000 a month, right? So in this example, we're saying your $1,000 a month is going to yield a $200 a month cash flow. Does that sound unreasonable?
Not for $100,000 house in today. You just got to factor in your neighborhood has changed over the last 2-3 years for that $100,000 home.
Yeah, exactly. I mean, it's definitely changed, right? But for the sake of the example here, it seems fairly reasonable. Now you can raise your rents on year 2 by 3%. So how much did you increase the $1,000 a month rent by if you raised it 3%?
$30.
$30. So provided, and I know there's an argument, taxes are going up, insurance is going up, provided that doesn't go up, we're just using round numbers here. That would mean your cash flow went from $200 to what?
$230.
$230. We'll take the 30, divide that into 200. You will find, since nobody else has a calculator here and I have it seared into my brain, your cash flow goes up by 15%. Do the math, guys. Take 30, divide it into 200. You're going to find that it goes up by 15%. And that's a compound growth. Every time you raise the rents 3% of whatever your current rent is, your cash flow will compound at 15% in an example like this. And it's going higher. You got people seeing 5, 8, 10, 12% increases in rents. And it may not be every year. It could be every other year, right? So, but still factor that in and you can see this compound growth. But what's happening to the loan? Does the lender get to raise the payment on the loan because of inflation?
Nope.
Nope, not at all.
Unless you got an arm.
I'm going to do another screen share here. All right, you guys see this this grid?
Yep.
All right, so what I'm showing here, and actually this is even a lighter inflation. I'm going off of an 8% inflation, showing $150,000 purchase price with 20% down, so you have a $120,000 loan amount. And we're showing that the individual who borrowed this money is responsible for $719.46 per month for 360 months. Now, over 30 years, they're going to use the renter's money to pay back the $120,000 principal plus $139,005.83 in interest for a total of $259,005.83. Most people are going to freak out about that because it's more than double what they borrowed, or approximately, it's right around double what they borrowed. They're going to want to pay this off early. Well, stick with me a minute here. Let me show you why you don't, right? So this is illustrating to you that whole process here and how much the lender's making, right? But as you noticed in this first column here, they are not ever increasing the payment. They have to accept the exact same dollar amount every month for 30 years. How much is the dollar going down in value right now, guys?
8.5%.
8.5%. When you do the math on that, that's 0.7% per month. The dollar's losing value. So I'm running this at 8. And the reason I'm running it at 8, if you go back to shadow stats, and you look what John Williams drew on that graph, we have stayed above 8% for the majority of the last probably 20 years. So that's why I'm sticking with 8% on this. Even though we're way higher than that right now, I'm just using 8 for the purpose of this transaction or this example. So now you get in here and we start seeing that what starts to happen over those payment periods, you start to see here, if you recalculate every dollar as you make a payment on that loan for the next 30 years, at 8% inflation, the dollar's eroding over that 30 years to where the lender's only making $98,050.61. That's less than what you borrowed, way less than what you borrowed. So who's winning in this example?
I am.
The government. Aaron, with this example though, was this an $80,000 loan?
This was a $120,000 loan right up here. Okay, $150,000 purchase price, $120,000 loan.
Just because we were talking about a $100,000 property, can we run an $80,000?
Sure.
Is this a live calculator on this?
Yeah, I can change it to the live calculator. I had this one in because I'm moving it to another thing, but I'll get the live calculator going and we'll put that in there.
Yeah. So I like talking about kind of the inflation arbitrage that we discussed. That what I love is the government has been saying for years they've been trying to get the 2% inflation going. And we've been paying, I would say the average investment rate for the last, 4 or 5 years has been somewhere in the 5% range. Would you say that's roughly right, Aaron, in the last 4 or 5 years?
They've kept it fairly low according to their numbers, but not necessarily is it.
But I'm talking about interest rates for homes for investment properties over the last 4 or 5 years, maybe averaged around 5%.
For investors, yes, around that 5% range.
So they were saying there was a 2% inflation. We were paying 5%. Now they're saying there's an 8.5% inflation rate, and we're paying 6%. if you look at that, it's completely flipped now. Now, even if they're right, even if Shadow Stats is completely wrong, if the government is right, we are paying less than inflation right now.
Oh, way less than inflation.
Yeah.
We're definitely going to get there.
Yeah. So, I mean, even at the 2% mark we were paying above, now the government is admitting that we are borrowing money for less than we are losing it.
What this reminds me of, or just is important to focus on, is actually less critical. It's more critical about what's actually happening right now, but just in big picture, people are so centrally focused on cash flow and how an interest rate is going to affect their monthly cash flow day one or year one, just based on that pro forma, that they almost lose sight of, like, this is why you're investing in like this type of stuff is exactly why you're investing in real estate. Big picture, a pro forma is an estimate at best at what year one performance is going to be. You really need to be running out your calculator to conceptualize the things that are more powerful to build your net worth, in factoring in rental increases, your debt reduction, your appreciation, even conservative, all those things compounded, your tax benefits and depreciation, which is one of the main strategies that why we continue to buy more and more real estate every single year. That's what really grows your net worth. And so you really need to get off this train of everyone else that is just so focused on the interest rates going up. Yes, it affects your cash flow, but look at it year 5, 10 down the line and see where you're going to be net worth wise, factoring in potential rent increases.
100%. And that's one of the main reasons why this tool exists, to be able to show people exactly what you just described. So as you'd requested, here we go, $100,000 purchase price, $80,000 loan, $532 a month, principal and interest for $191,000 paid over the entire 30 years. But I plugged in 8.5 inflation for this. We're at $69,220 in actual dollars paid to the lender. You borrowed 80, you're still less than that. Now, what interest rate am I running this at?
7%,
guys. That's even higher than what people are getting right now. The reason I bring up 7 is to show you 7's nothing to be scared of, because we're probably heading there, more than likely. In fact, the anticipation was we weren't going to hit the 6s till the end of this year. We blew right through the 5s in a week and a half. When we got through the 4s and we touched 5% for real estate investors, we blew right through it and hit 6 in a week and a half. We didn't have a chance to even settle into quoting 5 before we blew right past that. So I think we're heading to 7s at some point, but it seems like a little bit harder number to get to because of the liquidity in the markets at those higher coupons, which doesn't make sense to me. I can't wrap my head around why people would want to invest in a lower return coupon, but they are. So at 7%, you're still paying way less than what you borrowed. So that's why I tell everybody, you got to leverage high, leverage long, and pay off slow.
And take action now, right? I mean,
100%.
If this is something that's pushing you to not do anything, I mean, this is just a metric at time, but it's a tool, and you just need to know how you're actually factoring in. Most people are not going to the extent of actually calculating this out. They have a pro forma or a calculator that they're running a cash-on-cash return, right? And that's the only metric that they're able to visualize. And I get it. This stuff is actually high-level complex. This is taken, when Aaron first started teaching this kind of stuff, he barely had a goatee. So this is how many years
it gets caught in my belt now, guys.
Yeah. So this is how many, this takes time to visualize.
I just love the fact that, we talk about it right now. If you get in at let's even say 7%, like Aaron's talking about, you lock in your payment, you're able to raise your rents consistently, especially right now where you can lock in your payment and just, raise your rent 7, 8, 9% in most of these markets. And then eventually, most likely, the interest rate will drop and we'll get back down in the, maybe 5s or possibly even the 4s. And you can pull equity out of your property while dropping your interest rate. And you still, as we've seen throughout history, rents are sticky. Rents aren't going to plummet just because your interest rate did. And so, take advantage now, lock in your rate, start seeing your rents grow, and then later change your mortgage because, you've got equity and everything continues to work.
Yeah. You're still building the appreciation, you're building your equity, all that cash flow side, cash flow negative, even potentially, or break even, you're still getting an exceptional return on investment just from the debt pay down. like Aaron was talking about, year after year, some appreciation factored into that, your tax benefits and depreciation.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.